Good evening, everyone. Welcome to FSMOne Recommended Unit Trust series. So, as most of us would know that have also attended for our past couple of weeks event, during this time, this is when we have some of the well-known managers to give us some insights into their areas of expertise. So, for today, we have a very special guest. Her name is Selina. She joined AmInvest Equities team in 2007 as an analyst covering Malaysian properties initially. She then began as a lead portfolio manager for Asia Pacific REITS since its inception in 2011. In 2017, Selina is appointed to manage Asia Pacific ex-Japan mandate, where her key responsibilities also include not only managing funds, but also contributing to equity research for the Asia Pacific region. She previously has a graduate from the University of Warwick with a bachelor's in economics and also holds the Capital Market Service Representative license for the regulated activity of fund management. So I guess without further ado, I'll pass the stage to Selina. Are you okay if maybe we can start with Q&A first, while maybe perhaps your team is settling with the technical difficulties?
Yeah.
Okay, nice.
Okay, great. So,
maybe I can start off first. I believe that, especially during these times, perhaps maybe most businesses could be having to be more willing to hold cash instead of perhaps giving out as dividends to the shareholders. So during such times, should investors expect dividend yields to drop further downwards and perhaps maybe only recovering past 2021?
Yes, to be honest, that has been factored into earnings forecasts. Consensus is expecting a decline in distributable income for 2020 because of the current challenges, but these are expected to be largely short-term in nature, and then we should start to see some sort of recovery in 2021. That is the assumption for now.
I see. So
but,
yeah. Oh, sorry. Go ahead.
Yeah, so the thing about that is right now everyone is affected, so it's a question of sustainability, of landlords and tenants coming together to work out some tenable solutions to weather the current challenges.
I see. Is it all right if investors interpret this as the challenges that all these REITs businesses are facing are more or less already being priced into the price right now?
Yeah, I would say so, because we're 4 months into the pandemic, I would say, and in the case of China, it's been 8 months. So I think that people are better informed about the potential impact of the pandemic on businesses. And we have the necessary health and safety measures in place to deal with that.
Right. I also think that maybe even if correct me if I'm wrong, even if let's say, for example, there's a resurgence in COVID virus cases, perhaps most of the governments, maybe in not only specifically maybe perhaps in Asia, they would be more well equipped to tackle with all these challenges, right?
Yes. Sorry, could you repeat the question?
No. It's adding on to what you have mentioned earlier. So because earlier you've also mentioned regarding that one of the reasons also is because we are already in, let's say, 4 to 6 months into the COVID pandemic. So I was adding on to the point that most governments would also be more better equipped to tackle these challenges, even with resurgence in cases as well.
Yeah, absolutely. I mean, to be honest, governments did actually respond very quickly, coming up with the fiscal packages to help businesses as well as individuals deal with the impact of the pandemic. And that is a section which I will cover in my presentation now that Faris has my slides up and running.
Okay.
So I think we can actually get this show on the road right now.
Okay.
So everyone, thank you so much for your patience. Have to say like the pandemic, the technical difficulties were unprecedented, as we did a few test runs earlier and everything was running fine. But now suffice to say, we can actually make a start on this. So my name is Selina Yong. I'm from AmInvest, and I am the lead portfolio manager for the fund in focus this evening, Asia Pacific REITS. The theme tonight is steady income with long-term capital gains. That pretty much sums up the relevance of REITs, even in the current conditions, with all the uncertainty and volatility brought about by COVID-19. So it's a question that I've been getting a lot in the past 4 months, relevance of REITs as an investment class. And I'm here tonight to address some of those questions and some of those concerns so that investors are better informed. And the presentation will also cover certain things that I look at within the region, things that are on my radar, which feed into the investment decision process. So moving on to slide 3. So throughout the presentation, first of all, you'll hear me talk about 3 key markets: Australia, Japan, and Singapore. And this is mainly because these are the main REIT markets within the Asia Pacific region, by virtue of the fact that they are the more mature real estate markets. And you'll also hear me talk about 3 key sectors, being retail, office, and industrial. Traditionally, these are the key sectors within the real estate market, but then we'll break it down and going further into the subsectors. So first and foremost, we'll talk about the performance in June. The fund was down marginally at 0.64%, but this was on the back of some easing after a strong uptrend in previous months. I took a look at the July performance numbers, and the fund actually rebounded pretty strongly in the month of July, up 3%, against a benchmark performance of about 1.6%, according to data logged on Bloomberg. This is mainly driven by the Singaporean REITs, which were also up 3.15%. So just going back to June, just to do a bit of a recap of what happened. Part of the reason of the softness was due to the concern of second wave, particularly in Australia, as well as the impact of the pandemic on property in Japan. However, in Singapore, the economy started its reopening of the economy with phase 2 on the 19th of June, which meant that restaurants could then reopen, but with social distancing in place. On slide 4, it's just a summary of the macro events which took place in June and which I have to say extended into July, and that is equity markets globally continue to perform despite the risks of a second wave emerging. And I have to say that performance extended into regional REITs as well. Now on to the next slide. We're going to talk about yield gaps, which essentially is a way of comparing the returns, the dividend returns or dividend yield of a REIT relative to what you might get if you were to invest in equity markets in the Asia Pacific region. Now the question is, why REITs, right? As you all would be well aware of, the fact that global central banks have been cutting interest rates aggressively to support their respective economies. As a result, you'll see a lot interest rates in key markets such as Australia, Japan, Singapore are well below 1%. In Malaysia, it's about 2.9%, and this is on slide 6. However, if you were to invest in an Asian REIT, be it in Australia, Japan, Malaysia, Singapore, you're going to get a dividend yield of 4 to 5%. And this is assuming that even if share prices were flat. And this is why REITs are such an attractive investment at this time. So this yield is underpinned by recurring income. The REITs collect rental income from their various assets within their portfolios, which help to underpin or to support the dividend payments to their investors. And I see that Ferris has run ahead of me onto slide 6. Slide 6 shows you the historical trend of the dividend yield spread between Australia's long-term government bond yield. Sorry, slide 7 shows you the difference between the yield between the 10-year government bond as well as the dividends that you would get if you were to invest in an Australian REIT. And as you can see, the gap between the red line and the blue line has widened, even as interest rates have come down and the dividend yields have pretty much stayed relatively stable at around the 5% range. So this again makes REITs an attractive investment asset class. In Australia, there has been the Victorian government has reimposed some restrictions in light of the spike in COVID-19 cases, which has caused some concern, but later on we'll talk about where we are focused within the region to protect the portfolio returns. Moving on to slide 8. Slide 8 shows you the yield gap, the historical yield gap for Japan, which has also seen a spike up as a result of the spike up in dividend yields, as well as the flattish government bond yield, which is pretty much. We move on to slide 9, which covers Singapore. There is a bit more detail in Singapore, where the yields have been broken down by sector, and as you can see, hospitality or hotels and retail have a higher yield, and that's a function of the higher risks involved at this current juncture, where those two sectors are the most affected by the pandemic. In contrast, you see that industrial has one of the lowest yields, just above 4%, as a result of yield compression, because investors because of its positioning, which is to benefit from the pandemic. And I'll go into a bit more detail later on. So touching on the sectors now, you'll see that these sectors are what we like. And at the top of my list on slide 11 is the industrial sector, The reason being that the lease structures are more defensive. They are a longer WALE, and they are poised to benefit within the industrial sector. The logistics warehouses and data centers are poised to benefit from the increased digitization of economies through greater reliance on e-commerce, as well as more use of internet services such as teleconferencing or video conferencing. On slide 12, this is just an example of a good quality industrial warehouse owned by one of our top 5 holdings, Goodman Group. It's in these warehouses that your packages from the likes of Lazada, Amazon, eBay, Shopee are stored. This is where they're sorted and then eventually put on a truck and delivered to your doorstep. During the lockdown, there was a spike in e-commerce, which, as you can see on slide 13, is demonstrated in Singapore as an example. Online retail sales actually spiked up between March and April when the lockdown or the circuit breaker was imposed. So this doubled from 18% of total retail sales to 9%, from about 8 to 9% previously. And again, this will benefit the industrial sector, not just within Singapore, but also globally. It's a trend which we have observed across industrial REITs. Increase in demand for space by e-commerce players because of the spike in online retail sales. And in addition to that, companies have also been storing more stock within the warehouses to avoid supply chain disruptions as much as possible. Team talks about office, which is the next sector on my radar. Basically, a question that has been thrown around a lot is whether offices are going to remain relevant in the current environment where most of us are working from home. But I think that offices will continue to remain relevant because corporates still need a business address, as well as not everyone has the privilege of a conducive work from home environment. And also, in addition to that, research has shown that the transfer of knowledge is far more efficient in an office environment where people can come together and have a more collaborative experience. This is especially important for younger executives. So rather than offices being irrelevant, I would say that trends emerging trends would emerge which would lead to the evolution of the use of offices, and it's listed here such as more use of flexible space by corporates. So they might just need a meeting space for a short-term project or just for collaboration between team members. We might also see a spike up in demand for satellite offices which are closer to home so that people don't have to commute. But this might also put at risk some trends which were taking place in recent years, where corporates were encouraging their employees to hot desk, and also just because they wanted to reduce their office footprint. And it might also reverse the densification trend because of social distancing. So what that really means is that people would just need more space per desk to ensure that social distancing in place. And in fact, speaking to some of the office landlords in the region, they have seen some demand by tenants requesting for more space because of these reasons. So moving on to slide 15, where we talk quickly about retail, and unfortunately has been a casualty of the lockdowns and social distancing, with the malls having to be closed during the lockdowns. And as a result, retail REITs have had to offer rental assistance to their tenants. However, it's not all doom and gloom, because they will be able to recover some of that rental income through the repayment of rent, through installments over a given time frame, or through extension of lease. And I'll talk a bit more about that in my next part of the presentation, which covers the impact of COVID-19 on slide 16 onwards. So moving on to slide 17, what slide 17 shows you is how governments regionally have responded to the pandemic. And they responded in a very timely manner through fiscal response, Singapore being the most aggressive, and followed by Hong Kong and Australia. This is important for REITs because it provides businesses as well as landlords financial flexibility as well as assistance to weather the rather abrupt disruption to their operations. And further down the chain on slide 18, you'll see that this is a range of rental assistance offered by retail landlords to their tenants, which I think is crucial, because it not only helps to maintain the occupancy rates within the retail malls so that tenants don't go bust, but it also helps to provide rentals or income certainty to the REITs and therefore their investors. So as you can see on the chart, the rental assistance ranges from 1 to 2 months in Australia as well as China, to 2 to 4 months in Singapore as well as Japan. On slide 19, this is just about the coping mechanisms which REITs have deployed in order to preserve their financial resilience, which I think is important for the longer run. So I'm comfortable with what they have done so far, bearing in mind that everyone is assuming that the pandemic is, in the bigger picture of things, a short-term disruption. So first of all, there is the individual assessment of leases, where landlords are talking to the tenants, engaging with them, trying to get a gauge on what their needs really are, so that they can extend the appropriate sort of assistance to their tenants. And then secondly, there is the need to maintain occupancy rates, so that this essentially, in short, it's better to have a tenant paying a bit less rent than to have than not have a tenant and have zero income. I think most people would concur with that. And then on the other hand, the REITs are pretty much in cash conservation mode, putting on hold any non-essential projects or expenditure, so that they have that financial buffer. So we're going to move on to the outlook, which will be covered on slide 21. First of all, I think that COVID-19 has brought about some new norms for the foreseeable future. And I think that some of these changes may not be reversible so soon, unless, of course, we have a vaccine. But more importantly, it's also accelerated some long-term structural trends which already have been playing out in recent years, such as the adoption of technology. We're all meeting online nowadays. We're all communicating on Zoom, on Facebook Live, on Teams, you name it, rather than going out and physically meeting because of the need to social distance. I think we all can relate to that tuning into tonight's session. E-commerce as well. I think retailers are becoming increasingly reliant on the online channel. I don't know about you, but during the most severe
or the most stringent part of the MCO, I was on my phone a lot, shopping online a lot. It's just so much more convenient to be able to buy what you need on Shopee, on Lazada, rather than go out to the shops and have to deal with the checking in, with the constant sanitizing. By a click of a button, you've bought what you need, and in a matter of days, it arrives on your doorstep without you having to step outside. Of course, within real estate, there is the incorporation of more IT, more sensors to reduce touch surfaces, as well as a more efficient supply chain management, which then means that corporates need more warehouse space. As I mentioned, this then really reduces the disruption to the supply chain. So you're not going to get a situation where the shelves are empty, or rather, you're not going to get a situation where you don't have any toilet rolls because there weren't enough in the warehouse. So we think that there will continue to be demand for yield. And this is where REITs, again, come into play, their relevance. Interest rates are going to be very low for the foreseeable future. And investors need a bit more return versus your less than 1%, right? As I mentioned earlier on in the presentation, regional REITs are able to give you a 4 to 5% return on just purely based on dividend yield, even if share prices flatlined. As for M&A, which was the story for growth last year, we think that there could still be opportunities further out in the second half of 2020, but we think that it will be a bit slower because of the travel restrictions, as well as there won't be as many fire sales as we saw in 2008, because in 2008 there was a lot more balance sheet distress versus now, where corporates have been managing their balance sheets more prudently since the global financial crisis. So I'm going to talk very quickly about a portfolio strategy, which is on slide 24. Now, I position this portfolio bearing in mind the market uncertainties, so that whatever happens, the REITs in the underlying investments will be able to weather a bit of pressure, will be able to take a bit of pressure, so that at the end of the challenges, they would still be able to come out and recover more quickly. And hence, I have placed a lot of focus on balance sheet strength, asset quality, management strength as well, how proactively they manage their portfolio of assets, as well as their debt and cash flows, because these all feed into their ability to pay out dividends to their investors. So within that, you never can tell what could happen tomorrow, and hence I did diversify the portfolio, not just across countries, as I mentioned, but also across sectors, so that the portfolio will be able to pick up on any upswing in cycles across different countries and across different sectors whenever that happens. And, to a lot of people, market volatility is daunting. It makes your stomach churn. It makes my stomach churn. But to be honest, it also presents you with some great opportunity, and that's where we find there is value add. So it's where we can add to positions in REITs, which we really like for the long term, without having at a more attractive valuation. So that brings me to the end of my presentation. I'm going to talk about the fund very quickly. This is largely a marketing. My marketing team wants me to talk about this, so I will very quickly. Why REITs? Again, right. So I think that REITs do provide a nice base for a portfolio's returns. I was on a call earlier on today, and the speaker likened REITs to a good base for a cheesecake. Because without a good base for a cheesecake, you don't have the cheesecake. There is no structure. So I would say that REITs provide your portfolio with that nice, stable, defensive income, 4 to 5% per annum. REITs have been returning a total return of like 10, 15% per annum on a steady clip. Closer to home, the fund has performed well since inception, I would say, returning at 2011 versus and outperforming the regional benchmark as well as its own benchmark, as you can see. And slide 27 sums up nicely what we look at, where we are positioned regionally as well as sector-wise, what the investment strategy really is about. So this brings me to the end of my presentation, and thank you again for your patience with the technical difficulties earlier. I'm happy to take your questions.
Sure. Thank you, Selina. Thank you very much for the presentation that you have shared with us earlier on.
Okay, so...
Yeah, sorry.
All right. Okay, so I have a question from Facebook. Would Asia Pacific REITs be diversifying more into data centers and infrastructure REITs? And if so, any specific country?
Selina, can I maybe share like some of the...
Yes, I mean...
Selina, can you hear me?
Just give me a moment, please. Yeah, so we will be...
Hi, Selina.
We are already... Hi, sorry, sure.
No, it's okay, it's okay. Do you mind if I start off with some questions?
Yeah.
Yeah, sure, no worries. First of all, I'm really grateful that for the presentation that you have shared earlier. Maybe perhaps I can start off with one question that I believe that some of the investors might be thinking about.
Yeah.
So earlier on, you also mentioned in your slides regarding like why REITs. And I believe for most investors as well, that is also similar with them, in which REITs is actually their version of cheesecake. Right?
Yes.
So the base for the cheesecake. So in regards to, but really unfortunately that the REIT sector similarly has also taken a hit as the COVID pandemic spread across international borders. So one of my questions is really regarding how really should investors think about REITs going ahead? Like, does it really still forms the base to the cheesecake, or should investors really think about REITs as a different animal altogether?
Look, the pandemic has affected everyone. Okay, no one is spared, but it really is in which REITs you are positioned. First of all, interest rates are at an all-time low. They are like near 0%. As I showed you earlier, they are less than 1% within the Asia Pac region for the more developed parts of Asia. And you compare that to what a REIT can give you, 4 to 5%, and more specifically in Singapore, say 4%, right? As I mentioned, industrial REITs are strong beneficiaries of what has happened. through logistics warehouses as well as data centers.
Right. So investors, if I
So
sum it up,
sorry, if I can just add on to that.
Sure.
It really is how the portfolio is positioned. As I mentioned, it's about sector selection as well as quality. Because if you have a well-managed REIT with a strong balance sheet, that REIT will be able to deploy its capital and to drive its future growth through acquisitions. And if you have a good quality portfolio, and by that I mean good quality assets, the REIT manager would eventually be able to grow its income in the longer term through rental step up.
Yeah, so I guess investors can also interpret, if I may to sum up what you have mentioned earlier, investors can also interpret that as the REIT sector have also some very, very good exposure in the market as well, right? So moving on, I'm getting like one or two questions, very interesting questions in regards to Malaysia. We have noticed that the holdings for AmAsia would mainly revolves around, for example, Singapore. So maybe perhaps can you share why Malaysia is not really on the radar? Is it because that there isn't any interesting opportunities in Malaysia, or is it like you can find better holdings outside of Malaysia?
Yeah, so it's the thing about Malaysia is that it is less diversified versus Singapore. Singapore's REIT market is more mature, and I can say the same for Australia and Japan. They are more mature real estate markets to begin with, so there are more investable assets, and hence, they have a longer track record. With regards to Malaysia, there is also the issue of a lack of liquidity for Malaysian REITs. There are good quality REITs, don't get me wrong. It's just that they are very tightly held by institutions. So it's, firstly, there is the issue of liquidity to trade, and secondly, there's a lack of choice. There is greater diversity in Singapore, not just in terms of the universe, so that's the number of stocks, but also in terms of sector as well as geography. Because although you have a REIT listed in Singapore, its assets could be located offshore, could be in Australia, could be in Europe and in the US. So it just provides you with just so much more diversity.
I see.
Yeah.
I'm sorry, go ahead.
Yeah, in Malaysia, the larger, more liquid names have a tendency to be concentrated in retail.
See, speaking about liquidity, earlier you mentioned, I believe you also hinted in your presentation slides regarding that due to the COVID, a lot of policymakers have also started to drive interest rate lower, and especially lower for longer, and that has also caused liquidity to be driven into the market. So in this scenario of markets which are driven by liquidity, can you maybe share a little bit on how do you perhaps position your fund, or maybe how do you think about what would happen in the next 12 months? Perhaps maybe you can share a little bit of color to some of our audience.
Yeah, so for now, we're assuming that interest rates are going to remain low for until 2021, 2022. And the Federal Reserve Chairman, Jay Powell, has actually mentioned this. So central banks globally tend to look at that as an indicator. But also, if you look at how far along we are in 2020 and how we're still not out of the woods with regards to the pandemic, I think it's suffice to say that it would be too early or we'd be shooting ourselves in the foot to think that interest rates could go up in any time soon. We are in August. We thought that maybe, initially we thought that maybe COVID-19 would dissipate by the summer, and then maybe we'll see economic growth starting to pick up by year end. But so far, apart from certain parts of Asia, everywhere else globally is still battling with keeping a lid on COVID-19 cases.
Right. I believe in respect to time, apologies to our audience over here. Perhaps maybe we'll go with perhaps 1 or 2 questions before we call it a day. So I guess a few questions that I have left would be, because most of our investors over here put the probability is high for them to be to have a diversified portfolio as well. So can you perhaps share how many percentage that you think that for our audience over here, how much should they invest into REITs, this sector?
Oh, that's a loaded question. I can't say that. I can't give a recommendation because it's not covered by my license. But what I can say is REITs are going to continue to be in demand. But what we are going to see is polarization and investors being more discerning. So paying more attention to the better quality names and those REITs which are positioned in the right sectors so that they will benefit from the growth opportunities.
I see. Apologies, Selina, for putting you in this position.
No, it's fine. I get asked that question a lot.
Okay, great. So I guess my last question would be, can you maybe share with our audience, the last question would be like, why should investors invest into AmAsia? And as well as, perhaps can you share like what is some of the additional value add you can give to investors?
Yeah, I would say that the additional value add from investing in Asia Pacific REITs is because it's an actively managed fund. A lot of the value add comes from the bottom-up research and the long track record in investing in Asian REITs. Okay,
great. Okay, so that'll be the end of our webinar for today. First of all, I'm very happy and as well grateful for Am to be able to be here to share with us their insights into the REITs market as well. And I'm really grateful for Selina for that as well. So I believe there's a lot of interesting questions that's being asked, and for those of you who are looking to have your answers, please feel free to email investhelp.my@fundsupermart.com if you have any further questions. So don't worry if you are unable to find the webinar. It's okay. You just need to head to our Facebook and you give it a like. And over there, what you can find is that you can see most of our videos over there. So you can go ahead back there and review some of the points that we have mentioned in this webinar for your per user. So for next week, what we have speaker that's coming to speak for us is Jasmine Oi from RHB. So what they'll be speaking about is in regards to the fixed income opportunities in a low interest rate environment. So once again, very appreciative of Selina to be here. And thank you very much, everyone. Have a great night.
Thanks, everyone. Thanks, Sean.
Thank you.
Right. Have a good evening, everyone.